Well, this is really important, and I'm going to talk directly to the people here.
Absolutely.
I wouldn't expect anything, okay? The data is going to dictate what happens. Hi, this is Joe Harris. I'm here with Nick Morgan. How you doing, Nick?
I'm doing well, Joe. How are you?
I'm super excited because the Fed is going to release their results today. They met yesterday, the 19th, and March 20th, and they usually release their results at 2 p.m. Eastern Standard Time today.
Yes, sir.
I'm very excited about that.
Yeah, no, I'm excited to talk about it as well. For the viewers that might be a little bit unfamiliar with the Fed, what are they discussing in these meetings, and what are they deciding?
Okay.
More important thing.
What are they discussing? The Fed is discussing, they're going to look at the broader economy, and specifically, they're going to narrow it down to inflation. And they have a target of 2% on inflation. They want inflation to get down to 2%. Remember last year we had like a 9% inflation, and the target is like 2%.
Right.
And so we're steadily moving towards 2%, and I think we're down to like 3.25%, 3%-ish.
Okay.
2.6. I don't know. We'll find out today. And what they look at is they look at things like jobs and inflation and the cost of goods and services. That's basically inflation, and to determine where they are in that target rate.
Okay. And so with that information, what then do they decide at the end of their announcement or at the end of their meetings?
Well, one of their big tools is the federal funds rate. So the Federal Open Market Committee, or FOMC, meets 7 to 8 times a year to review the inflation, the economy, the data, and decide if rates need their federal funds rate, which is the rate at which banks borrow money, which directly affects things like credit cards, home equity lines of credit, car loans, maybe student loans. Personal loans, things like that. Doesn't affect directly mortgages.
Yeah.
Not to go too deep into that. Obviously, mortgages look at the same things because they're similar to those other things, but that doesn't directly affect those rates. But they're looking at the federal funds rate and to see if they need to keep it the same, lower it to stimulate the economy, or raise it up to pull back the economy and stem inflation.
I gotcha. Okay. So I think you touched on it a little bit there, but what are the most important factors that moves the needle on making that decision? Is it only inflation? Is that really only all they look at, or is there other big economic factors that they focus on?
Well, they're looking at jobs data,
Okay.
because they're looking at the broader economy, and a good indicator if the economy is healthy or not is the unemployment rate, and some of their labor rates, pay and things like that. They're going to look at those. So the jobs are very important. If there's jobs being created and a lot of job openings and low unemployment, well, that's going to be a more heated economy than, higher unemployment, more people out of jobs, more people looking for work, and less jobs being created and put out there.
Okay.
So they're going to look at jobs data. They're going to look at inflation data. They're going to look at core, they're going to look at pricing indexes, like what's the cost of the goods that go into the manufacturing process? What are the cost of goods, a bucket of goods that consumers buy, out there, food, shelter, things like that. And depending on the data, some of it looks at the cost of energy and fuel and food, and some don't. So they have a lot of different data that they look at to decide, hey, are we in an overheated economy, or is our economy slowing down?
Okay. So with the general sentiment of the economy right now,
Right.
what would you predict is going to be said this afternoon?
So I predict that the Fed's going to come out and they're going to say that there's no rate increase, but they're also not going to lower the rate. They're going to keep the rate unchanged.
Okay.
I believe that's what they're going to do. More importantly, it's what they say in that announcement, and it's the clues that they give about when they might affect rates, lower the rates. Or if we get a surprise, surprises are not necessarily good either, right?
Yeah.
So if they decide to raise the rate because they think the economy, the inflation's going the wrong direction and they got to raise the rate, that's a surprise no one's expecting. I shouldn't say nobody. Most aren't expecting.
Okay.
And we could see interest rates go up overnight because of that surprise. Conversely, if they say, hey, we're in good shape to hit that 2% funds rate, we realize we're not there yet, but we also know that if, we've had 11 rate raises in a row, and we raised it that much over a very short period of time, that we're heading in the right direction. We need to start lowering the rates in order to help have a soft landing. I don't think they're going to say that today. I think it's going to be, hey, look, we're going to keep it unchanged. We're watching this data very closely, yet be prepared for higher longer, higher rates for a longer period of time.
Okay. And most people are kind of expecting that unchanged status, correct?
Correct. I mean, it's baked in. It's going to, when I say baked in, all the talking heads, all the predictors, most of them are saying it's a very high percentage chance that we're going to stay unchanged.
Okay. So in that case, like you touched on a little bit, they raised it for quite a bit. I think it was 11 straight rate increases in a row.
They did.
And then now we've had a few just kind of unchanged, staying static at this level. When can people expect possibly a rate cut then? Is it going to be later this year? Is it going to be next year? Are they just going to keep it static this year? Like what's the timeline on that if you had to give one?
Well, this is really important, and I'm going to talk directly to the people here.
Absolutely.
I wouldn't expect anything, okay? The data is going to dictate what happens. I would not expect a rate cut this go around. I wouldn't even expect one April-May meeting, and it might not be until the June meeting that it happens. But until that data gets in line, and until we see, unfortunately, an uptick in unemployment or a closer, more in line every month on the way down inflation, the Fed's not going to want to change what they're doing. I mean, they started raising the rates in April of 22, and they had 11 rate increases in a row.
Okay.
So in a very short time, they raised the rates a pretty significant amount. And we had a rate in 2014, we started raising the rates 9 in a row, but it was done over a 4-year period.
Right, yeah.
Right. And then in 2020, the rates dropped down to 0 because of coronavirus, pandemic, whatever you want to call it. And and then this is a result of those 0% interest rates. We overheated the economy. We stimulated the economy with trillions of dollars we put into the economy, and we hadn't overheated. People weren't really incentivized. A lot of people weren't incentivized to work.
Yeah.
And they were given money, and they spent that money, and now we had inflation, right?
Yeah.
So now we're trying to pull that back.
I gotcha. Okay, sweet. And so the federal funds rate, whether it's cut, unchanged, increased, whatever, that's not, and we're talking about mortgages because we're in the industry, that's not the direct mortgage rate.
Correct.
But it does affect it. And how does that correlation work?
Well, it's a correlation because if the Fed's saying, look, inflation's high and we're going to keep the rates high, well, a mortgage is done basically, a loan is done. That loan is sold to Fannie Mae, Freddie Mac, or securitized through Ginnie Mae, and it's packaged up, collateralized with the property or put together with the property and sold as a mortgage-backed security, which is basically a bond. And bonds are fixed income, which just means that there's a face value. Let's say that's a $100,000 bond and it's at a specific interest rate. Well, we know if it's at 4 or 5, let's just say it's at 5%, $100,000 bond, then that's going to return 5%. So it's fixed. Well, if inflation's at 7%, you wouldn't want to go out and buy a bond for 5%.
Right.
So you're going to sell that bond. You don't want to hold this thing. You're going to sell it, and the price is going to be driven down. And so you might not pay face value for that bond, which means that you're getting effectively a higher yield or interest rate, right? Yeah. So you don't want to buy a mortgage-backed security at a lower rate. So you're going to sell it, and it's going to drive the interest rates up. Okay. So right now the interest rates have been driven up on those mortgage-backed securities due to inflation and its low demand for those bonds. And the Fed doesn't have a direct effect on that rate, but they're looking at the same data and they're saying the same things. Yeah. Right. So it's not directly related, but you can rest assured that if the Fed's saying that, hey, inflation's going in the right direction, you can pretty much be guaranteed that mortgage rates are going to go down because they're looking at the same data.
Gotcha.
To make that determination.
Yeah. No, that totally makes sense. And so then if the mortgage rates are affected in that way, how does the Fed affect the actual housing market, like the prices of housing? What would happen if they cut right now or rose right now?
Well, we'll look at it this way. The Fed's tried, they purposefully destroyed demand. They'll tell you that's what their job is. When they raise rates, they're destroying demand.
Gotcha.
They don't affect supply so much, right? And a lot of the issues that are driving inflation are supply driven. Housing, right? A lot of people don't want to sell their house. They have a 3% interest rate. They don't want to sell their house and buy another one with a 6 or 7% interest rate. Right. So the supply of housing out there is low. You can look at the housing supply is low. So energy, right? The cost of energy is very high, and it's higher than it was in the past. Oil is $80, $90 a barrel. Okay. Well, they're not going to be able to control. That's on the supply side. You can't control inflation just by destroying demand. All right. So they've been trying to they would have liked the home prices to come down. And so they raised the rates 11 times in a row.
Yeah.
And the home prices were extraordinarily unaffected by that. We stopped the 20, 30% increases we were going,
Right.
but home prices didn't shoot down in a lot of areas. Some places they did.
Yeah.
But the home prices didn't shoot down, even though they raised the rates 11 times, and mortgage rates were correspondingly affected, and we had some of the highest rates we had seen in 15, 20 years, right? But home prices didn't really change.
Yeah.
So if the rates drop, right, and that's on the demand side, then the supply is going to increase a bit because you're going to have sellers, and you're going to have more buyers that come to the market because a lot of people are saying, I'm not going to buy until the rates improve.
Yeah.
So you're going to see home prices go up. But
Right.
but that home price is a huge cost in the shelter piece. And that's looked at heavily under the balance of goods and inflation. So they really wanted to affect the biggest piece of a consumer's spending, which is their shelter, their house, their rent or their mortgage.
Right.
And it didn't really go down as affected.
Yeah. They were a little bit stubborn.
Yeah.
Yeah. But that totally makes sense. You probably have a lot of people on the sidelines waiting for that rate. So
Right.
when it drops even a little bit,
We're going to have a flood of people into the market.
Yeah.
It's going to make prices go up.
Even more.
Even more. And that's a concern of the Fed. So they're not going to be premature in dropping that rate. They're going to make sure that inflation is headed in the right direction. And they're probably, when their first rate cuts aren't going to be 3/4 of a point or a point. They might be 25 basis points or 1/4% to the federal funds rate. And they're probably going to, my opinion is they're going to ease it down over time. And one thing very specific to look out for in today's meeting and the announcements is that dot plot.
Yeah.
Okay. And the dot plot's a very simple term it's a very simple sheet that basically has a graph on there, and it has inflation on one axis and time over the other. And so in 2024, 25, and 26, these different Federal Open Market Committee members, they put on where they think the target rate's going to be in those years. And we've seen that revised different ways, but it's going to be very telling to see what they say about where they think rates are going to be, because remember, they have control over these rates.
Okay. Sweet.
Yeah.
Awesome. I think that's all the questions I had. I really appreciate the conversation.
Cool. Well, thanks for watching. If you have any questions, comments, concerns, let us know down below. We're going to we'll probably do a follow-up to this to let you know what the results of the meeting were, and how that should be looked at for mortgage rate and what that means. What that means. So again, hit the subscribe button and hit the notifications so you can be notified when that next video comes out talking about those results. And if you have anything we can help you with, let us know down below. We have our contact info down there, and we'll see you next time.